On December 12th, something happens in America that was never supposed to happen again. The money printers turn back on. $40 billion a month. A switch flipped in silence. A pivot wrapped in a new label. They're not calling it quantitative easing. They're calling it reserve management. A rebrand, a cosmetic disguise. But the mechanics are the same. Balance sheet expansion, liquidity injections, fresh dollars entering a system already struggling with rising prices. Watch until the end, subscribe, and remember this is not financial advice, because what comes next will change everything you thought you knew. They told us inflation was the priority. They told us rate cuts would be data dependent. They told us the money printer era was behind us. And yet, here we are. Printing begins before the year even ends. Rate cuts already underway. Inflation quietly heating. And a central bank insisting this is normal, temporary, routine. But beneath the surface, the signals tell a different story, a story of pressure, a story of fragility, a story of a system held together with promises that no longer add up. Powell stood in front of cameras and said the goal remains 2% inflation. He said the Fed is committed. He said Americans need real wages to rise. The words were confident, but the actions contradicted them. Cutting rates while inflation is rising makes no sense in a vacuum. Printing money while claiming discipline makes no sense historically. And starting with $40 billion a month, without an end date, makes no sense mathematically, unless the real story is hiding beneath the official narrative. When asked why the economy will suddenly grow faster next year, Powell blamed productivity. He said Americans will be more productive. He hinted at artificial intelligence. He suggested structural improvement, but no data, no model, no evidence, only hope. Hope presented as certainty. Hope used to justify a move that history shows is irreversible once it begins. And then came the stranger answer, why 40 billion? Why so much so fast? Powell said it was because of April 15th. Tax day. He said people will pay taxes, reserves will drop, liquidity will shrink, so the Federal Reserve must front-load the system 4 months early, at maximum volume. It was an explanation that answered nothing, a justification that revealed everything. This isn't about tax season. This is about fragility. This is about pressure building behind the curtain. This is about making sure the plumbing doesn't crack, because the system today is stretched thin. Treasury issuance at historic highs, debt rolling over at higher rates, foreign buyers stepping back, banks carrying massive unrealized losses, commercial real estate collapsing, households drowning in debt, and inflation refusing to settle. This is not stability. This is not strength. This is controlled turbulence, invisible until the moment it's not. Printing $40 billion a month is not a precaution. It's a symptom of a financial ecosystem that cannot function without injections, a symptom of a government that must borrow to survive, a symptom of markets that panic without liquidity, a symptom of a global order shifting under our feet. Because when America prints, the world reacts. China reacts, Japan reacts, Europe reacts, the Gulf states react, every central bank reacts. Money printing is never domestic. It is international pressure. It is global repositioning. It is the opening move in a contest over debt, currency, and influence. Every time the U.S. prints, other nations face a dilemma. Do they print to protect exports, or do they hold firm and import inflation? Either choice carries consequences. And today, with economies slowing, with conflicts spreading, with alliances shifting, liquidity becomes leverage, liquidity becomes strategy, liquidity becomes power, but it also becomes risk. Because history shows exactly what happens when printing begins while inflation is rising. The 1970s, the early 2000s, the post-2020 surge, the pattern never changes. Cheap money fuels demand. Demand fuels prices. Prices fuel expectations. Expectations fuel inflation. And once expectations move, nothing stops the cycle without pain. Every major inflation spiral in American history followed the same 4 stages. Dependency, weaponization, crisis, realignment. We are back in stage 2, printing as a tool, printing as a stabilizer, printing as a quiet form of intervention. The crisis that follows is not guaranteed, but the odds rise with every dollar created out of thin air. And the consequences will appear first in your daily life. In the grocery store, at the gas station, on your rent bill, in your insurance premiums, in the slow erosion of purchasing power. Because inflation rarely comes all at once. It comes in waves, each wave a little stronger, each wave a little stickier, each wave harder to reverse. When the Fed cuts rates, home prices push upward. When the Fed prints money, assets inflate. When assets inflate, the cost of living rises. And when the cost of living rises faster than wages, families feel the squeeze. A quiet tax on every dollar saved, a silent loss on every hour worked. A slow, creeping pressure that becomes the new normal. This pivot on December 12th sets the stage for 3 possible futures. In the first, inflation accelerates. The Fed prints more to stabilize markets. Asset bubbles inflate. Households suffer. The dollar weakens. Stagflation returns. Fast, violent, inescapable. In the second, inflation rises only moderately. Markets rally. Borrowing eases. Debt becomes manageable. Temporarily, a calm that feels like victory, but underneath pressures build. A fragile equilibrium, short-lived, easily broken. And in the third, global realignment begins. Foreign buyers reduce exposure to U.S. debt. Central banks diversify away from the dollar. Treasury demand weakens. The Fed becomes the buyer of last resort. Printing accelerates. A new monetary reality emerges. One defined not by stability, but by adjustment. A slow, grinding shift in global power. The next 90 days will tell us which path we're on. December 12th will show the first pulse of liquidity. January, inflation will reveal the first shockwave. Treasury auctions will expose demand or the lack of it. Repo markets will reveal stress beneath the surface. Fed speeches will telegraph urgency or denial, and markets will react before the public understands what is happening. Because markets always sense the direction first. And in every prior cycle, when the printing began, markets moved sharply, inflation followed, confidence wavered, and the real impact landed on households long before economists admitted the shift. December 12th is not a date, it is a signal, a pivot, a line crossed, a silent acknowledgement that the tightening cycle is over. Not because inflation has been defeated, not because the economy is strong, but because the system requires liquidity to function. And once that door opens, it rarely closes quickly. You may not feel it today, you may not feel it tomorrow, but you will feel it in prices and wages and savings and opportunity, in the quiet erosion of purchasing power that becomes permanent unless a dramatic correction follows. This is the moment the narrative shifts. This is the moment the pressure builds. This is the moment the next chapter begins. And that chapter is already unfolding, quietly, methodically, beneath the headlines. Subscribe and turn on notifications. The next update will matter even more than this one. Because what happens after December 12th will define the financial reality of the next decade.